How does a leaseback work? Have you ever wondered how a leaseback works in real estate investing? This unique arrangement can be a game changer for property owners and investors alike. Let's break it down step by step. A leaseback, also known as a sale-leaseback, is a real estate transaction where the owner sells a property to an investor or buyer and then leases it back immediately. In this setup, the original owner becomes the tenant, while the buyer takes on the role of the landlord. This means the seller can continue to use the property even after selling it. So, how does this process unfold? First, the property owner sells the asset to an investor, receiving a lump sum of cash from the sale. This cash can be used for various purposes, such as reinvesting in the business or paying off debts. At the same time, the seller and buyer agree on the lease terms. These terms include the duration of the lease, the amount of rent to be paid monthly or periodically, and other conditions that both parties find acceptable. Once the agreement is in place, the seller continues to operate in the property as a tenant, paying rent to the new owner while no longer holding ownership. From a real estate investing perspective, leasebacks offer several strategic advantages. One major benefit is capital releases. The seller can unlock the cash tied up in the property, converting it from an illiquid asset into cash that can be reinvested into higher return activities. Another advantage is operational continuity. The seller maintains uninterrupted use of the property, which is especially important for businesses that relying on that location. This continuity can help ensure that operations run smoothly without disruption. Additionally, risks associated with property ownership, such as maintenance, taxes, and market value fluctuations, shift to the new owner. This can provide peace of mind for the seller, knowing they are no longer responsible for these issues. For the buyer, a leaseback arrangement can provide long-term income. The buyer gains a tenant with a vested interest in the property, which often results in stable, long-term rental income. This can be particularly appealing for investors looking for reliable cash flow. Leasebacks are commonly used by companies that own commercial real estate but prefer to focus their capital and management resources on their core business rather than property ownership. The lease terms are typically negotiated to balance the seller's need for operational control with the buyer's interest in securing a dependable tenant. In essence, a leaseback works by separating ownership from occupancy. The seller sells the property to raise capital but continues to lease and use it, while the buyer gains ownership and rental income. This arrangement aligns well with real estate investing strategies that seek stable income streams and asset-backed leases.